Welcome to episode 117 of The Closing Table with Lawyers Title. I'm your host, Tamera Gaede, and today's guest is going to give us a mortgage rate update right after this.
Welcome to The Closing Table with host Tamera Gaede, where we break down how to be successful in real estate and what it's really like to work in the real estate business. This is The Closing Table with Lawyers Title.
Welcome back. Again, I'm your host, Tamera Gaede, and I'm really excited about today's guest because we've had some interesting things happen in mortgage rates today. I have Chris Pedison. He is a senior loan originator with Cross Country Mortgage. He has over 20 years in the business, and he is a top mortgage advisor that's been featured in D Magazine, Scotsman's Guide, and Texas Monthly. Welcome to the show, Chris.
Thanks so much for having me, Tamera. I'm really excited to be here and share some information and actually good news regarding mortgage rates in the mortgage industry.
Excited. Spoiler alert.
Yes, spoiler alert. Thank you.
No, and thank you for being such a good partner of mine. I really appreciate our collaboration and our relationship. So I'm excited to have you on the show. We're going to do a mortgage rate update.
Yeah.
Okay.
We are.
Well,
and along with other mortgage information too.
Yes. And one of the parts that we're going to talk about is how to turn this information into conversations that realtors can have with their clients.
Yes, absolutely. It's a big deal to be an educated agent that can educate your clients, which then sets you apart as the professional in the industry.
That's right. We like to separate ourselves, and differentiators is a big deal. But first, let's talk about rates. And today, what is today?
Today is February 24th.
Okay, that's important to know, right? And
absolutely.
So we woke up with some good news this morning.
Absolutely. So good news is rates have finally dipped down. The 30-year fixed average rate is now below 6% at 5.99%. That's amazing, guys. I mean, let me tell you, we haven't seen rates that low since September of 2022. And that's after we hit the high note of rates post-COVID back in October of 2023. You believe it or not, rates were at 7.875 and teetering over 8% during that time, which is insane, very high, but they were high rates. Now, hold on. Now, we're also talking about a lot of people have been waiting for this big rate drop, right? I mean, that's been the talk of the world is I'm going to wait till rates
slowly declining.
I'm going to wait till
I
rates
don't know about a giant rate drop.
Well, exactly. A lot of people are waiting for the giant drop.
Well, we've been waiting for them to go under 6, right?
Exactly.
We felt like that was going to be the tipping point to really start to get some mortgage applications to go up,
Absolutely.
get some refis cooking, which also will turn into purchases, sales and purchases for my realtor friends.
Exactly. And, I could tell you professionally, over my 20-year career in mortgage, the average rate that I've had over the last 20 years that I've, given to borrowers and, wrote loans at is 5.6%.
That's the average over your 20 years?
That's the average over 20 years. So interesting fact is we're getting close to that. And that honestly is what I feel like is a sweet spot for the market and for clients that are looking to purchase or anything out there is that, getting in that mid to upper fives, which we're already there and we're getting closer. So, I think that's exciting, where we're at. And just to kind of put it in perspective too, January of last year, so January of 2025, we were at rates that were right around 7.25%.
Boo.
Okay. Yes, I know. Not great. Not great. But, we're now 1.25% better than that. I mean, how awesome is that? And so these people that are still maybe sitting the sidelines waiting for these major rate drops, it's here. The time is now.
The time is now.
Absolutely.
And so we've been to a lot of economic forecasts in Q1 of this year, and they all predicted like kind of a flat year, that we would see a normal, robust spring market. And I think this is going to help kind of push that up a little bit more. So I'm really excited for my realtor friends.
Yeah, no, I mean, and speaking of forecast, I mean, we could dive into a whole long forecast, but I don't want to do that. I don't want to do that. Today. Yes, I don't want to do that. But, the projected rates for this year are right around like hitting a low point at some point of 5.7%.
Okay.
Which is right there, like I said, at that 20-year career average of mine at 5.6. We're literally talking about getting right there at the 20-year average. So I think that's amazing. By the way, the average rate includes like investment properties and other deals that I've done that typically carry a higher rate.
Yeah,
but that's just the average rate over the career. But so I'm excited to see those 5.7 rates at some point this year.
Me too.
And I think that's going to be great for all the sellers out there looking to sell their properties, along with people maybe looking to capitalize on some refinances.
I'm so excited right now. Okay, so let's talk about what moves the rates.
Sure.
Okay, let's make sure everybody has the education they need to understand this.
Sure.
Because you're talking about it even dropping a little bit lower this year. So what drives mortgage rates? Educate my realtor audience, please.
Right now, today's market, the things that are driving rates the most, okay, is number one, core PCE, which is what the Fed's favorite measure of inflation is, okay? So it's pulling out things like gas and energy prices because they can't really control those, and things that are impacted by the weather that they can't control as well. So that's why they call it the core PCE. So that's one of the big factors.
PCE.
Yeah.
What does that stand for?
Price consumption.
God, all these, whatever.
All of those things. Yes. But
there it is.
Personal consumption expenditures.
Say that fast 3 times.
Exactly.
Yeah.
So the other big thing is the labor market right now impacting rates. That's impacting a lot of the Fed's decision on what they decide to do is, what's happening in the labor market. And in the labor market right now, they are seeing, unemployment go up. Job creations going down.
Ew.
So, the labor market is not looking great right now, which isn't necessarily a good thing for our economy in general, but good for mortgage rates. Okay. And then the other big factor that they follow is the 10-year treasury bond. Okay. So anytime you guys are looking at CNBC or like the little tickers at the top of your TV, you see the 10-year treasury bond always. The 10-year treasury bond directly correlates with mortgage rates. And so when you see that going down, then you typically see mortgage rates also going down. So that's the, number one indicator of where mortgage rates are going. And then, of course, with that 10-year treasury bond, there's a spread. Okay, there's a spread between the, mortgage-backed security rates and that 10-year treasury bond. That spread has been decreasing over the last few years, meaning, that the servicing value of mortgages are increasing because less likely of early payoffs and things like that. So those are the big indicators. There are a lot of other ones out there, with what the Fed decides to do. That does impact rates, but a lot of people misinterpret as it's not the mortgage rate. Okay.
Like you got to make sure, because we see that all over Facebook.
Oh yeah.
Every single time they drop the rate.
Yes.
And hello, that's not the mortgage rate.
No, it's not. Not at all.
Please stop doing that.
It's not the mortgage rate drop.
I love y'all. Please quit doing that.
Yes. I mean, because, usually you'll see even when the Fed drops a rate, rates either stay the same or sometimes even get a little bit worse because of the comments.
It's already baked in. We're not going to see any major drop when a Fed fund rate drops.
Exactly. It's just, the comments after the Fed meeting is usually what moves rates the most, not necessarily what they do. Because the Fed's like, oh, well, we're not going to cut rates again. Like the Fed's whispering about maybe hiking rates again at this point, but that doesn't mean mortgage rates are going to hike. Okay. So we're excited. But yes, those are the big things. We're
looking at a new federal fund chair
in May.
So
absolutely.
We'll see what happens next.
See.
Okay.
Yes.
So are you seeing an uptick in mortgage applications right now?
Yeah. I mean, any time that the media blows up some sort of rate drop, okay, then we see an immediate uptick in mortgage applications, whether that's refinance applications or purchase applications. It's usually a good mix of both. And so, I mean, anytime you see, the media is blowing up like they are today, that, hey, we hit 5.99%, then I guarantee you we're going to see a lot more buyers entering the market and applying for mortgages, along with, my phone's been blown up this morning already with clients calling about refinancing.
Nice.
I like it when they call me and I don't have to call and solicit them.
Oh my God, isn't that the best?
It's great.
Well, and I tell my realtor friends, because I'm in a lot of settings where people ask, because I talk to so many realtors, what am I hearing? What's going on the street, right? Mm-hmm. And I always tell my realtor friends, check with your favorite loan officer first. It needs to be Chris Pedison.
Of course.
But check with your favorite loan officer first. They're the front line of what we're going to see in an uptick in the market, meaning the moment they see mortgage applications go up, they're first, right?
Yeah.
So you see the uptick in mortgage applications, then our realtor friends see an uptick in buyers and sellers, and we're on the back end. Title's on the back end. We're 30 days past y'all.
Exactly.
But if I stay in contact and I'm having a good relationship with my favorite loan officer, he's going to tell me, Tamara, I'm seeing an uptick in applications. And I want, even though it benefits me to obviously to have an uptick in refis, that still helps my realtor friends, right? That means the market is moving.
Exactly.
So y'all just make sure that whenever you want to understand what's coming down the pipeline, that you're talking to your favorite loan officer friend, and I'm hoping that it might be Chris. So anyway, okay, so let's talk about trends right now. Okay, so we're really excited. We have a 5.99 that was announced this morning. Please stay there. And then what trends are you seeing? And we're seeing some changes in programs. So my realtor friends need to be educated on that because they need to make sure, look, y'all need to know enough to be dangerous, right? You need a good partner that can educate your clients on what product is right for them, but it's still important for you to provide your realtor friends with the latest and enough knowledge that they can say, I have a lender that might have a program for you. Understood?
Absolutely, yes.
So let's talk about trends and changes in mortgage programs.
Great. Before I touch on that, I did want to mention, I mean, when you guys see these dips in rates and, uptick in applications, that usually also means the market's moving a little bit, okay? Which means opportunity or, maybe, the fact that the time to jump in the market is now before it gets a little bit crazy. We're entering that, kind of spring.
Oh, it might be too late.
We're entering that spring, summer market. And things start heating up along with the weather. And, and I know I'm a little chilly today, but
I'm really happy for summertime.
I'm just saying there's opportunity there. And those that are watching that maybe are still thinking about, I'm going to wait a little longer, see what happens. I mean,
get off the fence,
get off
people.
the fence. You got to get going.
Off the fence.
Yes, absolutely.
Yep.
But, with that said, yes, I mean, with the challenges in the mortgage industry and the real estate industry, we have seen a huge uptick in new programs coming out to help clients that maybe, have income verification problems or lower credit scores, things like that. These programs are called non-QM mortgages. Their popularity has gotten huge. I mean, to the fact of in 2024, all of loan originations in the nation, 5% of those were considered non-QM loans.
That's interesting.
Okay.
I mean, we've had a lot of conversations about those.
Yes.
Any type of pivoting financing, I mean, you see all of this kind of stuff come back to. This isn't the first time that we've seen all of this. It's always interesting because I feel like the loan programs kind of dictate what kind of buyers are
I agree.
in the market right now.
I do agree, but these non-QM programs in 2025 accounted for 9% of nationwide loan originations. So it almost doubled from 2024 to 2025. And it's expected to exceed that in 2026. And it's because these programs aren't like the ones that first came out, years ago. I mean, where, the rates were enormously high, fees were crazy high, and they were very tight boxes to fit in. I mean, we're talking about programs where you can verify income with 12 months of personal bank statements or business bank statements, programs where you can verify income with just a 1099 versus a tax return, programs where you can use a P&L versus a tax return.
Do these worry us at all?
No, because most of them are lower LTV loans, meaning they require a little bit more money down, more skin in the game.
Yep.
There are requirements, credit score requirements are a little bit stricter.
Okay.
And these are very make sense loans. But there's also at least our company and a lot of other companies that originate these allow tons of exceptions. So there's kind of some gray area there with the guidelines regarding these loans of reserves or debt to income ratios or loan amounts or LTVs. There are written guidelines, but they're all gray. And so if something, that the story makes sense.
Okay. We don't want to get back into a situation
no, not
like
at all.
we were before with all the...
No, and that's not what we're talking about here, guys.
Yep.
We are
We
not
need to
talking
be
about
careful.
stated income loans, except for DSCR loans require, that's another huge utilized ones right now for investors.
Yeah.
And that's a loan that you don't have to verify any personal income because it's all about the cash flow of the property that you're looking to purchase. So only investment properties is what that applies towards, but asset qualifier loans is another huge one for like high net worth individuals that just don't really have a steady income, but they have a ton of money.
Okay.
I mean, those are great programs too because they make sense. I mean, these people could pay cash for a property. They're just choosing not to, and so, and then I-10 borrowers is a huge one right now too. Those that have
I-10 borrowers.
Yeah, those are the ones that have, individual tax identification numbers, but not actual socials.
Okay.
But they're claiming income on tax returns and everything else like any normal citizen would. And, so those are great programs. Full doc programs too, even within the non-QM space are very popular.
Wait, what is this?
Full doc program. So meaning like you're not going one of these, unique, verifying income a different way, but you're verifying your income normally, but there's some sort of near miss why you don't qualify for an agency loan. Usually,
what would be a near miss?
a situation like maybe you don't have a full 2-year history of being self-employed.
Oh, okay.
Or, maybe there's a scenario where you had a bankruptcy 5 years ago.
So some of this could be applicable for my realtor friends.
Another huge, full doc non-QM perk is those that are looking to buy before they sell. With these non-QM products, if you have enough equity in that property, we don't have to count the liability of the property at all. And, just based off of the equity.
To a bridge loan?
It would be, but not really. It's
Okay.
not a bridge loan. It's a full doc purchase loan, just excluding the current primary residence.
That last qualification sounds similar to what the bridge loan
It does.
scenario or application.
But we are seeing
scenario
a
would
lot
be.
more bridge loans and buy before you sell programs too. The other big thing out there that's gotten bigger over the last few years is affordable housing programs.
I love those. I love those. I love
yes,
those.
absolutely. I mean, low down payment loans with rate incentives, mortgage insurance incentives, grants, all of those, down payment assistance. Those have become very popular again, for the low to moderate income people looking to enter the market.
Good, because we have an affordability problem.
Absolutely.
We need to help people buy houses. And so I love that.
Yeah,
so
and the only other loan program I'll say that we've seen a big increase of is equity loan products. Okay, like your home equity lines of credit, your second liens to cash out equity, or a home or a full cash out refinance, because a lot of homeowners are sitting on equity. And they want to stay where they're at, but maybe they need that equity for debt consolidation. Maybe they need it to go invest
Build a pool for $200,000.
Home improvements, invest it somewhere else. All of these things. I mean, that equity's tied up. So there's a lot of programs that allow you to keep your current 3% rate intact, but still pull out equity on a separate loan.
Okay.
And those are huge products that we're seeing right now too.
I love all that, and I'm glad that you have access to all those different products, because it helps you with diversification to find the right fit for the buyer. So I love that.
Absolutely.
So are we seeing mortgage applications requirements loosen a little bit?
So we are.
We kind of tapped into that a little bit. And by the way, let's be careful, y'all. Let's not get into scary land again.
No.
But it is important to help people understand if they are starting to loosen, to help more buyers get into the market.
No, they absolutely are loosening up a little bit. And we're not talking about crazy. We're talking about things like Fannie Mae rolled out this year where they don't have a minimum credit score anymore. Previously, a minimum credit score was a 620. Okay. Now there is no minimum credit score for a Fannie Mae loan. So Fannie Mae takes an average of credit scores of borrowers on the loan is what they do now, and calculates kind of risk that way. Usually, of course, if your score is low, there's got to be some decent down payments and things like that you're making. But, that's opened the door for a lot of potential home buyers or refinance opportunities, cash out refinances, because previously you couldn't even do a Fannie Mae cash out unless you had a higher than a 620 score.
Ooh.
Well, now you can if you need to.
620 is a lot.
A couple of other things that's kind of loosened up a little bit are, appraisal waivers with Fannie Mae and Freddie Mac type loans. They're actually allowing us to potentially, not always, get appraisal waivers up to a 90% LTV. Previously, that was capped at an 80% LTV, but we are seeing appraisal waivers for people that are only doing 10% down. Okay.
Interesting.
Or refinancing with only 10% equity. And that's huge. It saves people money and, the trouble and time of having and stress of doing an appraisal because the value is there and the system knows it. Okay?
Yeah. And by the way, appraisals have become very expensive.
They have. And, but one thing while we're on appraisals, I want to point out is, if we're talking about opportunities and things like that, we're seeing right now, most appraisals are honestly coming in higher than sales prices.
Nice.
Which is amazing.
That's another piece of good news.
That's a huge good news. And it's because of that opportunity of supply and demand out there right now. So good opportunities.
I mean, all of this is so great.
Yes.
I just feel like it's Christmas. Anyway, okay, so let's talk about what do you think leads to an uptick in refinances? And, I understand this doesn't help my realtor friends, but I still think it's very important because it's a piece of the puzzle, right?
Yeah.
So let's talk about what leads to upticks in refinances.
Well, obviously,
rate
drops do, okay? Number one, I mean, because the most common reason people refinance is to save money on their monthly liabilities, okay? And so rate drops obviously help with that. But what a lot of people don't understand, a refinance doesn't always mean, oh, well, I'm only going to refinance if I can drop 1% on a rate. Because that's the general rule out there. Is like, if you can drop 1%, it's typically a no-brainer at that point to refinance. But there are a lot of other times to refinance and maybe not even saving a full 1%. I mean, things like, lowering your monthly payment to get rid of mortgage insurance maybe that you currently have.
Oh, by the way, why would you? Okay, mortgage companies typically just remove that at a certain at when you get to you don't have to refi. So if you have 20% equity and your mortgage company hasn't dropped the PMI, you can call them and have them just drop that without having a refi, right? Because that's what I did.
Yeah, you can, but they may require you to pay for an appraisal, which if you're paying for an appraisal, then you might as well go ahead and do a full-on refi if you can get a better rate too. But they will drop it if it's technically you're at a 22% equity position.
Okay.
That's when they will drop it if you can prove that you're at that equity position.
Well, you guys take a look at your mortgage.
Unless you've got an FHA loan, then, that doesn't, you're stuck kind of with mortgage insurance forever unless you refinance.
Okay. Well, everybody take a look at your mortgage statements, okay?
Yes.
And if you've got 22%, you need to be calling your mortgage company to get that PMI removed.
But the other reasons people refinance, a lot of people right now are shorting their loan term. So like 15-year fixed rates are in the low 5s right now. And so, a lot of people are taking advantage if they got a 30-year fixed rate that's 7%. Then they're like, hey, maybe I could refinance to a 15-year and,
keep your payment the same.
Shorten my term, keep my payment close to the same and get something in the, right around 5%. I mean, that's, a big thing. Shorten term, taking cash out, like I mentioned before, is another big thing. Consolidating debt, too.
Oh,
that's a huge one, guys.
There's a lot of people with a scary, scary amount of credit card debt.
Yes. I mean, we have hit a peak at this point. I don't remember the exact stat. We can look it up. Yes,
and it was
but credit card debt has hit an all-time high.
Trillions.
I mean, it's huge. And credit card debts are 20%. So I mean, interest
20%,
rates, 20% interest rates
to 30%.
Yeah, exactly.
Like,
so
crazy to pay
consolidating
that
debt is another big reason to refinance right now. Switching loan type, maybe from FHA to conventional or those different types programs
wait.
too.
I don't want to skip over debt consolidation.
Yeah.
Because we have a lot of people that are just hanging on to our 2.5% interest rates for dear life, right? And we've talked about this on the podcast before with other guests, but I just feel like we have to keep covering this. If you have $50,000 to $100,000 in credit card debt and you're paying and you're paying 25 to 30% interest, it does not make sense to keep that 2.5% interest rate when you have cash in your house to pay it off. And now we've got a 5.99. What is it on refi? It's a little, it's still higher.
Refinance is actually probably a little bit lower.
Oh, they're lower. Yeah. Okay. A little bit lower. Like, you guys have to get on debt consolidation.
Yes.
Okay.
Yes.
It does not make sense to be so far behind and just drowning in higher interest rate debt when you can refi. It kicks up your interest rate a little bit, but then you can sleep at night. Like, I wouldn't be able to sleep.
Yeah. Because you're paying your minimum payments and getting nowhere. It's like treading water in the middle of the ocean.
You're nowhere because they're tacking on the interest rate every month, right?
Eventually, you drown from that. That's why it's important. And you could maybe even keep your 2% rate and do a home equity line of credit or some sort of second lien. And so that might be something you look into.
Look at that stat. 1.21 trillion to $1.28 trillion. That's a bunch of so much money.
That's a lot of credit debt.
Oh my God. That's just
yeah.
insane. And credit card interest rates 21 to 23.8%. Like, please reach out to your lender and let's talk about some debt consolidation. It just it just would, to me, would be such a stress reliever, and it would just help your family be able to keep moving down the road. And you'd probably have some extra money to go do something fun with your house or whatever it is you need to do. Whatever you need to do. But let's just really focus on getting that number down, because that is super scary. Anyway, okay, I want to pivot.
All right. What do you
Okay,
got?
so now we're going to kind of talk. We've talked about all the information that we need to know. Okay, now, obviously, we're really excited about the media announcement today, but the media hasn't necessarily been super helpful to us, realtors, right?
Correct.
We need to figure out how to filter through the media noise and really focus on what we need to apply to our clients, right?
Sure.
So talk to us, what should we be paying attention to? And what should we not be paying attention to?
Yeah, no, I mean, there's media catches headlines. That's their job, okay? And you're going to see a lot of headlines out there. Anytime, the administration speaks about anything or anytime Congress is speaking about anything, there's a lot of talk. Now, I encourage you to do a little bit of your own research, then follow the headlines. And meaning, look into what's behind the headline, not just what's on top of it. Because there's been talk this year or in the past 12 months about portable mortgages. Okay. That's basically been completely sidelined at this point. Probably not going to happen, but everybody got real excited about it and talked about it. And it's like, why are we talking about it if it's not real? In my opinion, that's what I look at. Or 50-year amortization. That was another big headline.
I was like, this is
another
not a
big
good
headline.
idea.
Again, that's kind of been sidelined too. Because
Not
a
a
lot
good
of these
idea.
things that we're talking about that, they may or may not do requires changes of laws, literally changing the Dodd-Frank Act and things like that like Congress has to do. So just because they're speaking about something doesn't mean it's actually going to happen. Okay. So like, for instance, the 10% cap on interest rates on credit cards, that was supposed
That would have been cool.
That was supposed to have already been implemented. But
Yeah.
I mean, how many
No.
people out there have a 10% interest rate on a credit card right now?
Nobody.
Exactly.
Probably
because
nobody.
the credit card companies don't want to do it. That's why.
Well, I don't blame
obviously.
them.
Yeah, I
That's
don't either.
Trillions of dollars.
Exactly. That's
Yeah.
a lot of lost money. Or things like, there was talk about FHA mortgage insurance being canceled at 78%, which I think would actually probably be a great thing, but that's just been talk. That, again, requires changes of laws to do that.
Okay.
There's also been talk about privatization of Fannie Mae and Freddie Mac. And, that's also something that could be a big thing in the mortgage industry, but not happening anytime soon. Because how do you know it's not happening anytime soon? Well, one headlines that is actually real out there is that the current administration has instructed Fannie Mae and Freddie Mac to buy $200 billion in mortgage bonds. Okay. That is something that is really happening, but it's not really been discussed at what pace that's going to happen, but it is impacting rates. But, obviously if the administration's kind of dictating what Fannie Mae and Freddie Mac are going to do, that means they're still backed by the federal government and, they're not going private anytime soon. Also been talk about, executive order to ban Wall Street investors on purchasing single family housing. Again, that's something that's been discussed, but not implemented and may not ever happen because it requires legislative action to do things like that. So I would just investigate behind the headlines instead of jumping on them and, giving your 2 cents of what you think and everything else. Like, it's like, if it's not real, why even waste the time talking about it, in my opinion?
Well, reach out to your favorite loan officer. Let's talk about what's real, what's not. Let's educate ourselves.
Sure.
And then we can have really great conversations with our clients. Okay, I got to wrap up. So I'm going to ask you one more question. This is, to me, the most important question of the day. Okay.
What do you got?
We need to educate our realtors on what they need to say to their borrowers based on all borrowers. That's loan officer.
Buyers. Yes.
Okay. So what do we say to our realtor friends that they can use as a script to either generate leads or generate conversation? Not even generate leads. It'll lead to it'll get to a lead, but generate conversation with our clients.
Sure.
Okay.
So I'll jump into that in 2 seconds. One thing I want to touch on is, why do we care so much about rates and everything else in the mortgage industry? It's all about the affordability, right? Affordability is the big problem we have right now. And as a realtor or a real estate agent advisor, you should be talking to your clients about affordability and solutions to the affordability.
Yes.
Things like, low down payment programs, things like down payment assistance, seller concessions to help with the closing costs, talking about things like, creative financing, whether you're doing a permanent interest rate buy down, temporary interest rate buy downs, things like that, getting creative with that. New property tax exemptions that are lowering property taxes, educating them about shopping for their mortgage and talking with the right people for their mortgage. MCC tax credits are another big thing to talk about to your, moderate income families. shopping insurance and what's going on in the insurance industry is another big thing. These are all things that you can do to, talk about affordability that's outside of interest rates. Okay.
Yeah.
But, also think it's important to have a script for when your clients or you're at a networking event and, you're going to get hit with these general questions all the time. Number one is, question is, how's the market?
Oh, Tom May talks about
how
that.
often do you get that?
He talks about going into social settings. He goes to a lot of networking stuff. He's a friend of the show and a friend of mine. Anyway, he talks about how he starts having these sort of conversations. And he's talking, we have a slide for this, and he goes through the same things that are on the slide. It's super smart, right?
Yeah,
and
yeah.
you don't have to deep dive into a whole lot of things. Okay. So we're going to put the slide up on the screen so that everybody can kind of understand, but wrapping this up. So give us a short script that realtors can use to start a conversation.
Great. Yeah. I mean, number one thing is, how's the market out there? That's the conversation that you get when you're even at the dinner table with your family.
Oh, yeah.
Okay. And it's always saying, hey, overall, currently the market is steady, which it is. Okay. And not like in 2021, but not slow either. Inventory is still relatively low. Demand is solid for well-priced homes, and pricing and presentation matter more than ever. Okay. The market you experience, really depends on your price point and your neighborhood. That's a perfect response to how's the market doing without deep diving and getting into specifics. Okay?
Love that. And that's a great place to stop for today.
Yes.
So if you need more scripts and want to understand more on how to deep dive into conversations with your friends when you're out in social settings, I really want you to consider reaching out to Chris. He is incredibly knowledgeable. If we haven't shown that today, I don't know what we're doing here. And so he's going to help you. And he even teaches classes about lead generation. So he is an incredible educator and wants to be a good partner to realtors. So Chris, amazing information today. Thank you so much for being on the show.
Course.
I reserve the right to have you back.
Well, thank you so much. I enjoyed it. And, just glad to share all the good news, and, that's out there in the market. It could be doom and gloom the way some people look at it, but it's not. It's actually all great positive news going on.
And that's a wrap on episode number 117. Again, I'm your host, Tamera Gaede. If you like my content, you're really going to love my escrow team. Give me an opportunity to talk to you about your title needs, and you guys go make it a great day.